So now that we've laid out the framework of what a company looks like when it emerges from growth into distress, what options does our company have now? Understand that what we've been looking at up till now, which is purely looking at how the market is reacting to expectations about this company's performance, note that those declines in market valuations, both of the stock price and of the bond and loan prices, alone are not the triggers of distress. The fact that stock price is going down and that bond and loan prices are trading at the levels that they are, that in and of itself doesn't usually trigger the distress. It just reflects the market's perception of or anticipation of distress. Theoretically, as long as you can continue to pay interest using, in our case, we have large cash balances, and you don't trip any covenants, there's not really a problem yet. You're going to be fine. Of course, the problem is, and it's sort of a bit of a circular sort of thing, and it's also probably why the stock is trading where it is. If you're not generating money, cash will run out at some point, so you may decide to get in front of the problem and try to address this distress. So the first thing that most companies do before getting into a financial restructuring, which is what we're going to spend some time talking about shortly, is they try to look at operationally what they can do to restructure the business. And so some firms have no hope of turning things around and are simply liquidated. We're not talking about those kinds of companies. The kinds of companies where there's just something that's gone so horribly bad that it doesn't make sense to try to restructure the business. Whether it's a business that sells something that's no longer needed, so think about, like a Sam Goody or a Circuit City, companies that have gone through bankruptcies where, they ultimately just liquidate. It turns out there's a consensus around the notion that they don't need to exist anymore. There's not a sufficient business need for them to exist, and there's no way for them to exist profitably. That's not what we're talking about now. What we're talking about now are companies that can conceivably exist as a going concern, but are having some sort of trouble. Either they're over leveraged or they're facing temporary problems where a restructuring is optimal. So one obvious way, getting back to operational restructuring, is to restructure the operations of the business, to improve the way the business is run through improved working capital management, through streamlining, processes. This means laying off people quite often, selling off underperforming assets. Now, companies in distress have likely been trying this approach or have begun to start trying this approach as they're getting these market signals from both their, usually this starts with equity and kind of starts trickling down to debt in terms of the signals around distress. At a certain point, management will actually retain some sort of restructuring advisor. If it gets to a point where things are really bad, they'll bring in restructuring experts. And there are advisory firms, both investment banks and consulting firms, that will help provide expertise and advisory services around, the most efficient ways to kind of start turning things around. Usually consulting firms are brought in terms of some of the working capital stuff, how to streamline processes and lay folks off. This kind of is in the purview of the turnaround consulting firm, and they'll help try to navigate through the operational issues. Now, companies for whom operational restructuring is insufficient, the next option is to convince, and when we say convince, we're talking about an out-of-court restructuring, or to compel, in which case we're talking about a Chapter 11 bankruptcy process, to convince or to compel the lenders to restructure their debt. So here we're going to lay out some of the benefits of doing something out of court versus the benefits of doing something in court. And hopefully by the end of the next several slides, you're going to have a sense of why some companies do an out-of-court restructuring while others do an in-court, and how the two may actually inform one another. So probably the single biggest reason why you do an out-of-court restructuring, why you don't file for Chapter 11, is it's less costly than a bankruptcy. So if your goal is to restructure the debt, in other words, to get your lenders to agree to take a haircut so that you can right-size your business, if you do it out of court, you're going to pay far less to lawyers and consultants, etc., than if you do it in court. In court, the legal fees can be massive, which drain the estate of critical cash at the time that it needs it most. The next advantage of doing something out of court is the speed. Out-of-court restructurings are usually much quicker than the bankruptcy process. A bankruptcy can take years. The one thing that I would say as a caveat to that is increasingly companies will do what's called a prepackaged bankruptcy, or pre-pack, where they agree to what the plan looks like, what the financial restructuring is going to look like before they actually file. So they try to get all the constituents, all the claims holders, to basically agree to what it's going to look like, and then they file basically a prepackaged bankruptcy where everyone just kind of goes through the process, signs all the documents, and the plan is declared. The last benefit that we'll list for an out-of-court restructuring is the process can remain fairly private in an out-of-court setting, which creates less disruption. In an in-court situation, all creditor claims, the list of company assets and liabilities and recoveries are all publicly disclosed. So that's an advantage of keeping it away from the public eye. So let's talk about the benefits of an in-court filing as opposed to an out-of-court restructuring. So first, imagine in an out-of-court situation, you have a harder time paying your bills, so collection efforts begin from the creditors. You might start getting eviction notices and eviction proceedings if you're not paying for you're not making your lease payments, right? So all of this starts to happen out of court when you are in true distress. Whereas in court, you get something called an automatic stay, protecting you from creditors. Creditors are not allowed to, outside of the context of bankruptcy now, to go through any sort of legal proceedings to get you to pay. They have to stop asking you to pay back money that is owed to them. Again, all of it now falls in the very structured and orderly bankruptcy process. The next and a major advantage of doing something in court, and ultimately why a lot of restructurings end up in court, is what's called the holdout problem. And what that is referring to, is that it's difficult to get consensus when you have multiple tranches of debt or multiple claims. Essentially, investors in an out-of-court situation may realize that as long as there are enough other investors participating in a restructuring, they may actually be better off not participating. What that means is, if you need a certain number of, let's say you've got a broad investor base in bonds, right? So bonds are these instruments where typically the investor base is fairly broad, and there may be 100 investors, even more. Well, you may be able to cure the distress if you've got only 60 or 70% of them to essentially agree to restructure their debt. But what that means is that the 30 or 40% of remaining investors it's conflicting for an investor to decide whether it makes sense for them to take the haircut or to not. If they take the haircut, then they're part of solving the problem. But if they don't take the haircut, they're going to be made whole as long as there's sufficient other investors agreeing to get the haircut. So this creates a problem. Now, there are various mechanisms that are in place, even out of court, to try to solve the holdout problem, but often it's the holdout problem coupled with literally just the practical feasibility of getting that many constituents with various interests to agree that moves the process in court. And in court, the recoveries are agreed to as part of a plan which applies to the entire class. So whether or not you as an individual investor agree or don't agree to the plan, once a sufficient number of people agree, it applies to the entire class. The next advantage of an in-court restructuring is financing. As you can imagine, in an out-of-court scenario, you're going to have virtually no access to new financing. So if you need to borrow money to get anything done during this tumultuous process, lenders are not going to be pleased or at all interested in lending to a distressed business without the protections that are afforded to them in bankruptcy. Whereas in bankruptcy, what's called financing during bankruptcy, it's called DIP financing or debtor in possession financing, becomes available as the DIP lenders are protected via priority status. So the court will provide priority status over all the other loans, sometimes even super priority status, where they get priority over even secured lenders, right? Which they couldn't just arbitrarily provide out of court. You couldn't just say, come in, lend us some money, we'll give you priority over secured creditors. You can't arbitrarily do that out of court. So you're not going to have lenders lending to you out of court, even if you would agree to a super high interest rate. So again, major advantage of in-court is financing becomes available. A few other things to talk about in terms of advantages for an in-court process. And one is, and this is a very significant one for specific types of businesses. Ultimately, it may be why you file for bankruptcy in the first place, is to get out of these contracts that you can't get out of court. So let's talk about it. Out of court, you cannot just arbitrarily nullify leases or pension contracts. You cannot just null and void contracts. As you can imagine, you can't do that. In court, Non-financial liabilities like pensions, unfavorable leases that you may have signed into a 30-year lease that's totally unfavorable now as the economics of that location have changed. Contracts can be rejected. All of these things can be rejected in court. And these are sometimes the very causes of the financial distress. So imagine a retail business with tons of unfavorable leases that they've signed into over the years. You can now go lease by lease and reject the unfavorable ones. There's a framework for how you go about doing that in bankruptcy that you simply cannot do out of court. The next thing to think about are taxes. There are some tax advantages of filing as opposed to doing an out-of-court restructuring. The most notable one is that something called cancellation of debt income, right? When you exchange debt, when you basically force your lenders to take a haircut, if you think about the accounting for that, is you are recognizing essentially a gain by getting something for nothing, right? So you used to have this liability, and let's try to sort of make this simple. If you had a $100 liability, and you're able to exchange it for now a $20 liability. So there's a debit on your balance sheet, changing your debt from 100, right? So let's put this to 100 down to 20. Well, the offsetting entry is a gain, right? A credit to retained earnings via a gain, which is actually called cancellation of debt income, or CODI. Now, that gain is taxable outside of bankruptcy. So you would end up perversely paying taxes here on this exchange, whereas in bankruptcy, you will not, right? So you no longer have to pay taxes on CODI income. The next advantage of in-court versus out-of-court is acquisitions. If you sell assets outside of bankruptcy, the lien on the assets that you've sold stay with the seller unless the seller satisfies the lien, which creates risks for the buyer, right? So imagine you're a buyer and you are buying some assets, and now there's still a lien out on the assets that you've purchased that the seller's lenders have a claim on, right? So obviously that's going to prevent doing an acquisition unless, again, unless the seller satisfies that lien, which may or may not happen out of court. If you do that, then it's fine. But if you can't, especially as we get into some of the issues around what constitutes satisfying a lien and who actually holds a claim to that lien, it all gets a little bit murky in bankruptcy, which pushes the advantage to the in-court, where assets can be sold free and clear of any liens, which provide critical protections to potential acquirers in bankruptcy. So if you're thinking about selling off portions or your entire business and you're in distress, you're ultimately going to be far better off doing that within the in-court process. Okay, so let's change gears a little bit and start talking about what an out-of-court restructuring plan is going to actually look like. So what are these plans? How do you figure out what makes a good plan? What's a plan that's going to enable a company to emerge as a going concern, but also get agreement by all the providers of capital, all the various claims holders? So the reality in distress is that the original lenders and vendors are probably blaming management, and there's a lot of bitterness, right? Everyone probably thinks that management is screwed up in some way, and often they have, in terms of why they're here in the first place. Why are they in distress? The thing that's offsetting that is that there's an incentive to cooperate. Otherwise, you're going to have a liquidation scenario, which means lower recoveries to everybody. So you have this tension of kind of everyone's angry at everyone, but there's also this incentive to cooperate.